And the conclusion is, we've been saying this for the last 18 months, that we are in a rolling recession. It started 18 months ago with 2 consecutive negative quarters for real GDP growth at an annualized rate. And since then, one sector after another has stumbled. So housing, for example. Housing, by many metrics, is down 40 to 50% on a year-over-year basis. That is a recession. In fact, it's worse than a recession. We've gone back to COVID lows. We're not far from 08, 09 lows. And remember, the housing crisis is what started that global crisis off. Now, we don't think a global crisis is going to happen today, and certainly not because of housing, but sales have stopped because interest rates, mortgage rates are approaching 8%, and many people are quite happy to live in their homes with their 2.5% to 3.5% mortgage rates. They're certainly not going to roll them over into higher rates. And then we have autos. Autos were hard hit during COVID, and we would have expected them to soar and stay at high levels for quite some time. They did have a V-shaped recovery, but they have come back in and they are below par. I mean, this 15.5 million units at an annual rate in the U.S. is more consistent with a recession than a recovery, and especially for the traditional auto manufacturers who are losing share to electric vehicles. Sure, they've got their own participation in that space, but 90 to 95% of their sales are still gas-powered vehicles. We now have government gridlock. What happened with the House Speaker being ousted suggests that the government could shut down in the next 6 weeks. So I know there's a lot of nervousness around government spending, which up to now has been a stimulant. We think the next year, election year, is going to be more along the lines of gridlock. Gross domestic product, so real GDP growth and real GDI growth, or gross domestic income growth. They should be the same. GDI equals GDP, and yet they're not. In the last year, the GDP growth rate has been, in real terms, 2.4% on a year-over-year basis, which is okay. It's fine. It's not a boom, but it's steady as she goes. GDI, on the other hand, is up 0.2%. It had been down. It's up 0.2%. Essentially, no real growth, and corroborating this view of a rolling recession. We tend to believe GDI more. GDP is revised more because it's much more complicated to calculate it. You've got consumption, all the areas of consumption and investment and government spending and trade and inventories. Lots to measure there, whereas on the GDI front, we're measuring income, and we get those metrics from tax authorities and others, so much easier to measure. So we would lean towards GDI, which says this economy's very sluggish at best. Rolling recession seems right. Today's employment report was a big upside surprise after months of downward revisions, and this month was an upward revision to some of the prior months. So the upside surprise, I think, was 337,000, around that, versus nearly double the expectation. So that's interesting, but here again, we have something for everyone. The household employment survey, as opposed to the non-farm payroll survey, suggested that employment growth was only 86,000. Now that tends to capture more small businesses. And so at the margin, perhaps small businesses are fraying. We did see in the ADP report this week that large businesses continue to lay people off, and the challenger layoff rate also is up more than 50% year over year. So again, lots of cross currents, something for everyone. One of the numbers that struck me in today's employment report was the duration of unemployment. So the unemployment rate stayed at 3.8%, which means the labor force is growing fairly dramatically to absorb that 337 increase in employment, number of jobs out there. But the duration of unemployment, so those who are unemployed are beginning to see significant increase in the duration, up from 20.4 weeks on average to 21.5 weeks. That's a big jump for that particular metric. On the inflation front, we have some disconnects. I think the biggest one, and we'll get into this when we get into the charts, is the oil price. That tends to influence inflation psychology. And yet, in the University of Michigan report, inflation expectations came down quite a bit. So that was interesting, and we'll get into that in the charts in a moment. On a year-over-year basis, the CPI now is 3.7%. There's another metric out there that the private sector measures. It's called Trueflation, and it measures millions of goods and services constantly, and it is at about 2.5%. So that's interesting. It's the oil price going up has weighed on the stock market, but why not on consumer inflation psychology? It's because gasoline prices are starting to come down, and refiners are probably getting hit. We'll go into that in the charts. Also on the inflation front, you've been hearing about Tesla's price cuts. Well, it just cut the Model Y price again, a very popular car. And the Model Y, on a year-over-year basis, the price of it is down 27%. And now that's important because it's becoming more competitive than a lot of gas-powered vehicles out there. And on top of that price decline, consumers can get subsidies. And some of the subsidies, depending on the state, are quite large. So this is very tough for traditional autos. And my guess is you're going to see an unraveling of auto prices.